Good afternoon, and welcome to Gray, and Gray's webinar on the tax consequences of the Patient Protection and Affordable Care Act, or more commonly known as the new healthcare reform laws. I'm Mark Keshkagian, a partner at Gray, and Gray, and want to welcome all of you to today's webinar. We are very pleased to have so many business owners and friends from around the country with us today. We appreciate all of you for taking the time for this important presentation. I hope that you will learn more than you expect today. Now on to today's topic, the new healthcare reform laws and what they mean to you. Our presenter today is GG&G's tax partner, Mike Coppell. Mike has been closely involved with the evolution of this important legislation. Mike understands the tax landscape as well as anybody in the country. And more importantly, Mike is adept at translating the complexities of these laws into language we can all understand. One technical point before we begin. I know that we are going to have a lot of questions as we did yesterday when we gave this same webinar. If you have a question during the presentation, please press the Raise Your Hand button on your screen. We will get to that question either right away or a little bit later in the presentation, whichever is most appropriate. Without further ado, I'm very pleased to present my partner, Mike Coppell.
Okay, so let's start. There's my ugly picture. There is my email address. We'll talk about the importance of that later. Please understand, if you have any questions and we don't get to them today, you can always email them to me at that email address, or you can call me and I'll be forwarding everybody my email and telephone and cell phone address numbers so that you can reach me if you have questions now or in the future. Okay, I have a rule. My rule is that as a presenter, my political opinions are not relevant and should not come into play. What we're talking about today is a highly charged political subject. I am not going to get into any of the politics intentionally. If you want to raise a comment, that's fine. I will not respond to any political comments because I don't think they're relevant. And what we're talking about is how this is going to affect business and individuals in general. We will also not be talking about the individual mandate. A great deal has been written about the individual mandate. However, what we're talking about here is how this affects business people. I don't expect a whole lot of business people to have issues with the individual mandate, so we're not going to discuss it. What we're talking about, and what we're going to be talking about for the next 45 minutes to an hour, is considered the largest tax law change in the last 20 years. Let me repeat that. What we're talking about is the largest tax law change to occur in the last 20 years. Now, please understand that we have a great deal that we do not know. We don't know about it as far as the individual taxes are concerned, and we especially don't know about it when we start talking about the employer mandate. The IRS, the DOL, and Health and Human Services kind of laid back until after the Supreme Court ruled. So they have a great deal of catch-up to do as far as what the actual regulations for implementation are concerned. We know a lot more about the individual tax situation than we do about the employer mandate, but we know enough about the employer mandate so we can give you some of the basics of it so that you can get a basic feel about what this may or may not cost you. It is very important to recognize that this legislation gives a specific definition to the term high-income individuals. A high-income individual is anyone who has, any single person who has modified adjusted gross income of $200,000, anyone married filing joint who has income, adjusted gross income of $250,000, and anyone married filing separately who has AGI of $125,000. Now, as one person pointed out to me yesterday, what is interesting here is those of you who are married filing joint, we often hear the term marriage penalty. All right? In some of the things we're going to be talking about here, there is a marriage penalty. It is very obvious that looking at this, that a single person at $200,000 and a married filing joint where there are two incomes is only $250,000. There is somewhat of a marriage penalty built into this legislation. Now, there's a lot of discussion, there's an awful lot of political discussion, a lot of discussion that you're going to hear with regard to this legislation and other legislation as to what is a taxpayer's fair share of taxes. Please understand, it has always been my opinion that everyone should pay their fair share. Everyone should pay on all of their income, but they should also take advantage of all of the tax breaks, deductions, and credits that are available to them. With that in mind, let me tell you how I define someone's fair share. My definition of fair share has always been that you pay tax and I don't. All right? Whenever anybody asks you for your definition of fair share, that is the best answer to give to avoid getting into an incredibly difficult political discussion. Now, what is adjusted gross income? If you take a look at your tax return and you pull it out, all right, you'll take a look at page 1, first page of your tax return, and you take a look at the bottom of page 1, the bottom right-hand corner, and you will see a number. That number is your adjusted gross income. Basically, with one minor exception, which has to do with excluded foreign income, and if you have some of that, give me a call and I'll tell you how it's affected. But that number on the bottom of page 1 is what we're talking about. It is important to recognize that is before any exemptions for you or your dependents, and it is before any itemized deductions or credits. So that in a large sense, this is almost your individual gross income that we're talking about here. First part of individual tax that we're going to talk about. And we're going to talk about earned income. Earned income is a very important term here. All right? There are a lot of different forms of doing business. You can have a partnership, you can have an S corp, you can have a C corp, you can be an employee, you can be an owner. All of those people have different types of earned income. And what we're talking about here is any type of earned income that you have. If you're an employee, we're talking about your W-2. We're talking about your wages. And that includes employees of C corps and S corps. All right, we're going to talk about S corps a little bit more in a little while. But all we're talking about in an S corp is your salary. If we're talking about an LLC or a partnership, LLC tax is a partnership, we're talking about guaranteed payments. We're talking about any other income that you have as a general partner. Basically, and we're going to talk about this some more, anything that you have as a non-managing member, highly technical term, and if you're an LLC, we can talk about that, a non-managing member of an LLC or a limited partner who is not active in the business, that amount is not going to be subject to the 0.9%. But as we're going to talk about, that may be bad news, not good news. All right? So that's the first thing to remember. The next thing to remember is how much this is supposed to raise. This part of the law is anticipated to raise $86.8 billion over 10 years. $86.8 billion over 10 years just for this part of the law on the 9%, on the 0.9% income. Now, for those of you that are responsible for doing payroll, there is a requirement here. And the requirement is that if a person earns more than $200,000, you have to do the additional 0.9% withholding on that amount in excess of $200,000. Now, I've spoken to all of the major payroll companies, and they're all ready to do that so that it shouldn't be an issue. What I'm making sure people understand, because this starts in 2013, is please make sure that they're doing this. They say they're going to do it. I believe they're going to do it. But you as a you are responsible for making sure that withholding is done. So please make sure it is done. Now comes the fun part. Let's suppose that we have a couple, and both of them are successful, and both of them have wages of $175,000. Because neither of them reaches $200,000, there is no additional withholding. I take their two salaries together, and I have $350,000. That $350,000 is $100,000 in excess of the $250,000. Therefore, they're going to be subject to 0.9% tax on that $100,000, which is $900,000 that they're not expecting. We believe that it's very important because we're using relatively small numbers compared to what some people make, right? Because we have clients, we know of people who have significantly higher payrolls and significantly higher partnership income. All of a sudden, when we start talking about bigger hundreds of thousands of dollars or millions of dollars of earned income from partnerships, this starts to add up very quickly. And what we want to make sure people are aware of, and we're going to be working with our clients, A, to minimize that, we'll talk about that, and B, make sure that in April 2014, when this stuff comes up, people haven't spent that money on a trip around the world or a boat. Why plan now? I believe in planning at all times. However, let's talk about S-Corps first. We have to understand what S-Corp law says. What S-Corp law says is that an owner-employee of an S-Corporation has to take reasonable compensation. What's reasonable? Eye of the beholder. Who is the beholder? The Internal Revenue Service. How are they going to determine what is reasonable? One of the ways they're going to determine what is reasonable is based upon the past history of what the people have been taking as payroll in the past years. So if somebody has been taking $1 million a year of payroll out of their S corporation, and then all of a sudden in 2013 that drops to $250,000 a year, the IRS is going to come in and say, wait a minute, stop. What happened to the $1 million? Was the $1 million, if the $1 million was reasonable, why did it drop by $750,000? Shouldn't we put an additional 0.9% tax on that additional $750,000? We believe that we have to start planning if we're going to do reduction in S Corp wages. We have to start doing that now. Why is it important? Someone that is actively involved in their business as an S Corp shareholder, their S Corp wages are going to be subject to 0.9%. Their distribution of earnings is not subject to 0.9%. So basically, by planning the amount of wages and taking the action now to start planning it, we can save tax. And that is something that we're going to be doing, and we're going to be talking about an awful lot with our clients and friends over the next few months. Let's talk about partnerships and LLCs tax as a partnership. And let me start off by saying that I believe that partnership taxation is one of the most complicated, if not the most complicated area of the tax law. What was the question? I was just going to get home. All right. First things you have to understand about a partnership. Spouses in a partnership, a husband and wife or whatever, spouses are treated the same way in a partnership. Whatever way one partner is treated is the way the other partner is treated, be they active or passive. Now, you just heard me use the words active and passive. We're going to talk about that a little bit more. Whether or not you are actively involved in a business is very, very complicated. We'll talk about it briefly in a few minutes, but it is vitally important when we talk about partnerships. As a partnership, all right, one of the things I want you to look at when your accountants, be it us or someone else, prepares your 1065, your partnership tax return, I want you to look at the top of page 5 of the partnership return. Yes, I know You get your partnership return. Maybe you look at your K-1. Maybe you don't because you assume that your accountant is taking care of everything, and you have never looked at the top of page 5. You don't even know what page 5 says. What the top of page 5 does is it indicates whether or not you are a general partner or a limited partner. This is going to be extremely important in determining whether or not a person could be subject to the 0.9% because a general partner is probably going to be subject to that 0.9% almost by definition. Your guaranteed payment, and we do a lot of partnership returns, a lot of LLC returns, and we believe very strongly that the managing member of an LLC should be compensated for their service, and we give them a guaranteed payment based upon what we believe is a fair value for the services they provide. Once again, that guaranteed payment is self-employment income, it's earned income. We have the same issue here that we have with the wages of shareholder employees in an S corp. We're going to want to take a look at that, and if that number is much over $250,000, we're going to look and take a look and see whether or not we should be doing something with that. And again, because the IRS looks at that and looks at the trends, if we want to do something, the time to start doing it is not going to be in 2013. The time to start is 2012. Now, I don't know if there are any people out there that are involved in real estate. If there are, one of the things that I want to bring to your attention is something that's called a real estate professional. I don't want to get into exactly what a real estate professional is, but it is basically someone who spends all or substantially all of their time in the real estate professions, real estate developer, real estate manager, so on and so on. The advantage to these people is that because they are a real estate professional, if they have rental income, and you will understand in a little while why rental income is what we're talking about, if they have rental income, that rental income is now considered to be active trade or business, but it is not considered to be self-employment business. Therefore, we have active business, which we'll see why that's important, because it is rent. Rent, by definition, is not earned income and is not subject to self-employment tax and is not subject to the 0.9. And we're going to see in a little while why the definition of active is going to be so important when we talk about the 3.8% tax in a few minutes. Now, you thought 0.9% was bad? The lesser of investment income, which we're going to talk about the definition in a minute, or the amount of investment income in excess of high income is now going to be subject to 3.8% tax. This is scheduled to raise $123.4 billion over 10 years. Now think about the two numbers. What I just described is almost $210 billion of additional income on high-income people over the next 10 years. So let's talk about what we're saying. Investment income is taxable interest, does not include municipal interest. It is taxable interest. It is all dividends. It is rents, which is why we talked about real estate professionals. If you have net income, net rental income, that is going to be included in investment income. It is royalties, and it is annuities. Right? All of those, anything that exceeds $250,000 is going to be subject to an additional 3.8% tax. But it doesn't stop there. Net gain on sale, which you may know of as capital gains. Certain capital gains are also going to be subject to the 3.8% tax. And in this case, we have another definition. All right? The definition on capital gains subject to the 3% tax is the net gain from the sale of property other than property held in a trade or business that is not passive. There's that word passive. But let's talk about what it means, property held in a trade or business. Let's suppose that I own a retail store, and I decide to sell all the assets in my retail store, and it has a gain of $1 million. Because my retail store, right, is my trade or business, the sale of those assets for the gain of $1 million is not subject to the 3.8% tax. That is unless I'm not active, if I'm passive. Let's suppose, for example, that I own the retail store. However, I'm a CPA. I don't run my retail store. I'm never at my retail store. I have a manager and a staff who do everything in the retail store, make all the decisions, and do everything else. I am passive. Right? Now, we're going to talk in a few minutes about what passive means in Internal Revenue Code Section 469, but let's say I put no time in. What that just said is because this is passive, not active, that 3.8% is going to apply to that $1 million. So this comes back to why it's very, very important that we establish, starting in 2012, whether you are active or passive in any type of pass-through entity, and that's something that we are going to be doing a lot of work with our clients over the next year. Now, those of you that do a lot of financial reading may have heard the term capital gain harvesting. I am not here as a financial planner. I am not here to tell you what to do. However, capital gain harvesting is a term that is very common out there, and what they're saying is that because of the additional 3.8% tax, it may make sense to sell those assets that have capital gains in 2012 and avoid the 3.8% tax. The articles that are talking about this are also saying that the capital gains rate on high-income taxpayers may increase from 15% to 20%. And we all heard that discussion that's going on. But what that would say is if that comes true, that means that the capital gains rate would go from 15% up to 23.8%. Right? So that's why people are talking about capital gain harvesting. In my view, we should talk about capital gain harvesting at least until we reach the middle of November. When we get to that point, you should be sitting down with your financial advisors, sitting down with your tax advisors, seeing whether or not it makes sense on a case-by-case basis. That's something we'll be doing with our clients and helping them with. Now, I mentioned Internal Revenue Code Section 469. Internal Revenue Code Section 469 tells you whether or not you actively participate in a business or you are passive in a business. If you go back a couple of slides, what you're going to see is we said that whether or not you actively participate in a business is going to determine, A, whether or not you're going to may be subject to the 0.9%, because if you actively participate in a business, you may be subject to self-employment tax. However, understand, self-employment tax rules are entirely different from active and passive rules. That's something that we have a meeting with our partners and managers next week. We're going to have a long discussion about planning some of this out for our clients and friends. It is really important that you understand and you sit down with your advisors and make sure that you properly plan out, A, whether you're subject to self-employment tax, B, whether you are active and passive. Remember what I said about capital gains. If I am actively involved in my retail store, I am not subject to the 3.8% on that $1 million capital gain. If I am passive in my retail store, I just incurred 3.8% tax on $1 million. Once again, the IRS has the ability of hindsight. You can't do this all in 1 year. You have to plan it. The important thing that we are stressing and the reason that we're having these discussions so early in the process is the importance of planning, especially for pass-through entities like LLCs, partnerships, and S-corps. Oops, sorry. Now, I was playing tennis up in Waterloo Valley. My wife and I have a small condominium up in Waterloo Valley, and we were playing tennis with some people last weekend. And somebody asked me a question, because I happen to be talking about this. Somebody asked me a question and said, would it make sense for me to convert my IRA from a conventional IRA to a Roth IRA in 2012? And I said, well, we're all standing here hot and sweaty, and this isn't the time to get in depth. But it may be a good idea because as a traditional IRA, you're going to have to take mandatory required distributions every year for the rest of your life. And that's going to add to your adjusted gross income and increase that adjusted gross income and bring you closer or bring you over that $250,000 amount. However, if you convert from a traditional IRA to a Roth IRA in 2012, you're going to have to pay your ordinary income tax on that amount, which may be a good thing depending upon what you do for gift and estate tax planning, which is, again, an entirely different issue, but is something that you should talk about with your financial planner or tax advisor. However, a Roth IRA has no required minimum distributions, and therefore that amount, because there's no required distributions, that IRA income or 401k income would not be added to your adjusted gross income and may keep you under the $250,000 a year. Once again, every situation is special. Every situation requires individual planning, but we're strongly advising people, start planning now. Don't put this off until the end of the year. Definitely don't put it off until 2013. Now, the next thing my friend up in the valley said is, I can beat this. I'm just going to take all my investments, and instead of having them individually, I'm going to put them into a trust. And I just cackled and said, no, 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 trusts do not escape. And basically what happens here is that the less, again, this is fairly complicated, but the lesser of your undistributed investment income, that interest, dividends, capital gains, which is not distributed out of the trust, that amount in excess of the highest tax bracket, which is approximately $12,000, is going to be subject to the 3.5% tax, 3.8% tax. So once again, we see that in this case, this doesn't work. There really is no way getting around this. Right? They actually were pretty good in what they drafted to stop that exit strategy. I want to talk about a couple of other minor or not so minor, depending on how it hits you, things that are in this legislation. I've been doing taxes for close to 40 years. And basically for at least 35 of those years, the IRS has wanted to codify, specifically bring into the tax code, something that's called the economic substance doctrine. And what that says is you cannot do something for the sole reason of tax avoidance. Every transaction you do has to have a business purpose, otherwise the IRS can throw it out. They've been trying to put that in the code. This legislation does that. For those of you that are larger employers, and in this case a large employer is anyone that has 250 or more W-2s. You'll notice I did not say employees. I said W-2s. So that means if you're in an industry such as the QSR, fast food, retail, staffing, any of those industries that have high turnover, you can have less than 250 employees but have 250 W-2s. If that is the case, starting with this year, 2012, you're going to have to include on that employee's W-2 the amount of health insurance that you provided for your employee. And I don't remember what box it goes into, but once again, when I talked to the payroll people, they said they are ready to do that, but you're going to have to provide that information. Now, I am old. I am 65 years old. So if you look at the bottom line here, this doesn't apply to me. All right? And it also doesn't apply to my wife, because what the rules are is that for those of you that are younger than I am, those of you that are under 65, both husband and wife, the floor for your medical deductions, that amount that you have to exceed in order to get any itemized deduction for medical expenses, increases in 2013 from 7.5% to 10%. Now, the other day, somebody asked me why this was done. And I kind of laughed and said, there is no why. In the final analysis, everything here as far as this was done in order to accomplish certain tax thresholds and in order to make the legislation revenue neutral or to have it raise certain revenue. So that's why this is in there. All right? Now, this is actually called a Cadillac plan. It's not a Mercedes plan. All right? But basically what it says is those plans, called Cadillac plans, high-end health plans, starting in 2018, if the health plan costs more than approximately $28,000, and yes, there are plans that do cost more than $28,000. We have clients with plans that cost more than $28,000 today. If that is the case, the insurance company will have an excise tax of 40% of the cost of that plan that they're going to have to pay. And we know what's going to happen to that 40%. It's just going to be tacked on to all the rest of our plans. But this starts in 2018. A lot of you have FSAs, flexible spending arrangements, and basically there were not a lot of limits on what you could do with that. Starting next year, there is a new limit on FSAs. Starting in 2013, the maximum amount an employee can put into a flexible spending arrangement has been reduced to $2,500 effective next year. These are the minor things. Now comes my favorite, okay? And I just added this slide the other day, actually after I had talked to a lot of people. And what this slide says is the Patient-Centered Outcomes Research Institute fee, okay? The PCORI for any plan year, that is the plan year of your health insurance plan, and for plan years affecting after 9/30/12. Gray, and Gray's, for example, is 12/31/12. We're going to have to pay, our insurance company is going to have to pay $2 for the average of every life covered. Notice I didn't say $2 for every participant. So, for example, Mike and Tina are both covered by the Gray and Gray health insurance plan. It is not one person, it is two people. So that basically when you're talking about all the people that are covered in this plan, it is $2 for each life that's covered. Now, this applies to not only plans by insurance companies. I know we have several of our clients that are self-insured. For those companies that are self-insured, the self-insured company is going to have to pay $2 per average covered life for plans ending on or after ending after 9/30/12. Once again, this may not be a lot of money, but I just found it an interesting little tidbit, and it's something that is coming up right now. Now comes the other fun part. Let's talk about the employer mandate. Right? When you talk about the employer mandate and you hear different people talking about it, you may hear them use the word pay or play. So basically what they're talking about is you either pay the penalty or you play and get involved in providing health insurance for your employees. There's a tremendous amount we don't know in this area, IRS, DOL, and Health and Human Services haven't provided all the information that we need yet, but we think it's important that employers understand the amount of exposure that they may have starting in 2014. We in Massachusetts have a slightly different type of mandatory health insurance. It's a little bit different, but we have a lot of experience in this area, and what we've seen is that certain industries are hit much more hard than other industries. For example, the Massachusetts health mandate and the federal mandate isn't going to affect Gray, Gray, and Gray. We have high-quality master medical health insurance that we provide for their employees. I hate to admit I don't know exactly how much we pay, but I know we pay the vast majority, if not all, of the single coverage, right? So that neither one is going to affect us. However, that is not true of the QSR, the fast food and restaurant industry. It's not true to the retail industry. It's not true of the staffing industry. And it's not true of the construction industry. We have seen those industries have tremendous amounts of additional costs here in Massachusetts. Now, who is this going to hit? You're going to hear that this is aimed at large businesses. Let's define what a large business is. A large business is any business that has 50 or more FTEs. Okay, Mike, what's an FTE? An FTE is a full-time equivalent employee. Right? That is not full-time employees, it's equivalent employees. So, for example, if you have 200 employees and each of them works 25 hours a week, right, you're going to add that up, and basically that's way more than the equivalent of having 50 employees working full-time. We don't know the exact definition of full-time employee of FTE yet. Here in Massachusetts, it's approximately 2,000 hours a year. So what you do is you take all of your employees, take all of their hours, up to 40 hours a week, add all of those together, divide by 2,000, and that's the amount of full-time equivalents you have. That's basically the calculation we expect to see in this case. Now, one of our clients I was talking to last week and said, Mike, I know how to beat this. And I said, I'm dying to hear this. They said, I'm going to take each of my enterprises and I'm going to break them up into different entities so that I don't have 50 full-time equivalents in any of them. And I just said, no, that doesn't work. The law specifically says that related party entities all count together when we talk about 50 full-time equivalents and other parts of this law. Now, one thing you have to recognize is that when you read the law, what they specifically talk about here is that they are looking for, and we'll talk about the real terms in a minute, they want the effect of major medical insurance. They don't want what's called a mini-med plan. Mini-med plans basically are plans that say, okay, we will pay the first $4,000 of expense, and everything after that is your problem in a year, lifetime, whatever. Those plans don't count. We are looking at true major medical plans here that are going to have to be paid for. So what do we have? What are we looking at when we talk about the employer mandate? We are talking about the employer providing minimal essential coverage. We don't exactly know what that means, but it comes very close based upon the definitions that we've seen. It comes very close to basically saying this is major medical. In addition to that, you have to be affordable. And basically they define affordable as no employee having to pay more than 9.5% of their income from this employer for their single coverage. Now, what happens if you don't? If you do not provide that, and this is a very important word, and you'll see why it's important in a minute, you get a penalty of $2,000 per full-time employee. A full-time employee is defined as anyone who works on average 30 hours a week. Now, the good part of this is that the first 30 employees full-time employees that you have are free. So what does that mean? Let's suppose that you have 80 full-time employees. That 80 full-time employees means that the first 30 are free. Therefore, you now have 50 employees that you have to pay the penalty on. 50 employees at $2,000 per employee means that it costs your business $100,000 a year. It gets worse. Because I use the word penalty. Unlike in other places, for example, here in Massachusetts, this is not a penalty. Federally, this is considered a penalty. Penalties are not deductible. So basically, that $100,000 that you just paid is not going to be deductible for federal or state taxes. Now, when we sit down and we help our clients and work with our friends in determining which is going to cost less, to pay the insurance for our full-time employees or to pay the penalty, we're going to have to take into consideration everybody's tax rates, because this is not deductible. It becomes even more painful. Gets worse. If an employer fails to offer an insurance that equals at least 60% of the covered expenses, or the employee has to pay more than 9.5% of the income, and at least one employee gets a premium credit exchange. All right, before I turn the page, premium credit exchange means that this person, this family, this employee, their earnings are less than 400% of the poverty level, which means they are going to get a credit against the cost of them going to the exchanges to buy insurance. If that is the case, then instead of $2,000 per employee, it becomes $3,000 per employee. However, the good news is, in all of this math, it cannot exceed that $100,000 that we previously calculated. So basically what we're going to be looking at when we do this for most of our employees is we're not going to pay that much attention to the $3,000. We're going to be doing it based upon the maximum exposure that we have on that full-time employees at $2,000 per employee. Now, I know we have several clients, and I know we have a few people on this call that have self-insurance plans. The government currently is conducting a study to determine whether or not they should continue to allow self-insured plans. The results of that study probably won't be out for at least another 3 or 4 months. We don't know what the results of that are going to be, and we'll be keeping track of it. But it is clear that self-insured health plans are targeted for possible, emphasis possible, we don't know what's going to happen, but possible extinction. Okay, I want to bring up, as a lot of you know, we do year-end seminars that we've been doing for, this will be the 25th year, and I want to let everybody know what the dates of them are, so that you can set aside the dates now and come to our seminars. We have 3. We have one that is November 28th, which will be done at Westboro, the same place we've been doing it for several years in Westboro, right on the junction of 495 and Route 9. My favorite seminar is the one we're going to do on November 29th, and that's being done here in our Westwood office. That is my favorite seminar because that is exclusively for our clients. There are no bankers, there are no attorneys, there is nobody there but our clients. And we can really talk in a very straightforward way because we don't have to worry about anybody there other than the business people that we know and know us, and we can really talk in a very, very straightforward way. If you are our client, and I hope you all are, and you're anywhere near the area on November 29th, you really should come to that seminar. We really get a lot done. We have a lot of fun, and a lot of people cry at what they're going to find out, but that's okay because we're there to provide a lot of information. The last seminar is going to be November 4th, once again at our Westwood office, and that is open to anybody. At the current time, which may change, we are not planning a webinar for our year-end seminars. That may change as time goes by and we see what's out there. Right now, this is all that's planned. We do have other webinars planned on some other things that are coming up that are important.
Mike, we have some questions.
Okay.
This one came in early on, and I think it has to do with the trap slide that you showed. The question is, does that include the W-2 earner and the LLC income together?
The answer is yes. What we're talking about is all of your earned income. So the question was, does that include, on the 0.9%, does that include the W-2 earner as well as something that can be earned from a partnership? And the answer is yes, it is all of your earned income. So it is a self-employment income that the person earns from their partnership as well as what the other spouse would earn from their W-2. All right, so it is indeed, once again, a trap in that area.
We also have another question here, and that is, do we have to track general partner shares of interest on K-1s or other partnerships invested in the original, and will it be taxable at each level?
It will not be taxable at each level. It will only be taxable and what is actually distributed to the partner. This is not a partnership tax. It is a tax at the ultimate individual level, but we're going to have to track all the way up. And what is important in doing that is when we're tracing things up and down along on a chain partnership, it becomes really important when we start talking about whether people actively or are passively involved at each partnership level. And that becomes even more important when we talk about whether or not they may be subject to the 0.9% or maybe subject to the 3.8%, depending upon what is in that partnership and sales with that partnership. I want to go back to one thing on that. There is one thing that we don't know, and let's go back to my sale of the store. All right? What I said is I'm going to sell this store for $1 million gain, and I'm not going to be taxed on it because those are assets used in a trade or business. The question that I've asked, all right, and I've been unhappy with the answers because I don't have a good one, is that what if I sold the stock of my retail store? All right, would that be there? And I've gotten two different answers from two different friends of mine fairly high up in the IRS chain. One said it is going to be subject to the 3.8%, and one said it's not. So the answer is we don't know the answer to that question. That is something we're going to be looking for the IRS to give us regulations on. All right.
Okay, we have another question. What if the employee has a large deductible to cover? Does that count towards the 9.5% income level?
The question is, what if the employee has a large deductible?
Yep.
I don't know what it means. What does deductible mean? Well, the answer is, if we don't know whether a deductible meaning that they have to cover the first certain amount of expense, if that's the question, that probably will not qualify as a major medical, all right? Because basically most major medical plans have co-payments, not minimum deductibles. So that what you're going to see is that most of the high plans, like, for example, the one we have a plan here at Gray, Gray & Gray that says the first either $1,000 or $2,000 is deductible as a cost of the employer, of the employee. We reimburse our employees for that, but my gut tells me that is either going to be a cost of the employee or is not going to be allowed at all. We're going to have to see what happens when the regulations come out later this year or early next year.
That same person, Mike, just added the employee covers the first $4,000 of expenses.
Once again, we don't know the answer. My gut tells me that is going to give you a real problem when you talk about $4,000 and you talk about the 9.5%. But we're going to have to see exactly what the regulations are going to say about that high coverage environment, and we're waiting for those to come through.
We have another question here, Mike. I understand that the employee cannot pay more than 9.5% for individual coverage. What are the requirements for family coverage, and do I even have to offer family coverage?
The answer is yes, you have to offer family coverage, but the requirement for how much you have to pay, same as it is in Massachusetts, only applies to the individual plan. It doesn't apply to your family coverage amount. Okay?
Okay. Yep.
Okay.
If there are no other questions out there,
okay. Once again, if you have questions, if things come up, give me a call, send me an email. I tend to get in very early. I tend to answer the phones here from about 6:30 till about 6:45. When others get in, you can call the office, and I will answer the phone. Please, we will keep track of this as it's going on. As things come down, we'll be sending out additional information. As things come more clear, we will have an additional webinar or whatever for everything to make clearer. Thank you very much for attending. Starting to pour here in Westwood, but I wish you all a good day. Bye-bye.